This is Nightly Business Report with Tyler Matheson and Sue Herrera.
War of words. Investors are rattled after a North Korean official says the U.S. has declared war. Hitting their limit, home prices have acted like there's nowhere to go but up. But are they getting so high that no one wants to buy? New game plan? How do you please both your employees and your customers when your brand is at stake? Those stories and more tonight on Nightly Business Report for Monday, September 25th. Good evening, everyone, and welcome. I'm Sue Herrera. Tyler Matheson is on assignment tonight. Stocks fell, gold rose as tensions escalated between the U.S. and North Korea. Earlier in the trading day, North Korea's foreign minister said his country has the right to shoot down strategic U.S. bombers, even if they're not in North Korean airspace. One strategist said that made the market nervous, and stocks dropped sharply. The major U.S. indexes did recover some of those losses by the close of trading. Here's how they looked. The Dow Jones Industrial Average dropped 53 points to 22,296. The Nasdaq was off 56, and the S&P 500 was down 5. While North Korea got a lot of investor attention, so did something else. Bob Pisani explains.
Tensions are on the rise once again after a war of words between President Donald Trump and North Korean leader Kim Jong-un escalated today. North Korea's foreign minister said Trump has effectively declared war on the rogue nation and that North Korea now has, quote, every right to take countermeasures, including, he says, the right to shoot down U.S. bombers even when they're not in North Korean airspace. We've heard a similar exchange of threats for a while now. The markets have mostly shrugged them off, but this marks the most direct warnings North Korea has issued so far. Gold prices spiked more than 1% on heavy volume to break firmly above the $1,300 mark. Bond yields dipped to one-week lows, putting back stocks under pressure and lifting real estate, consumer staples, and utility stocks. Those are defensive names. And the volatility index, the VIX, widely thought of as the best gauge of fear in the markets, rose to the highest level in 2 weeks, though it's still low around 11. Despite these moves, the bigger story lately has been rotation. There's been plenty of sector rotation in September. We saw it again today. Just take some of the Dow leaders and laggards, for example. Chevron and Exxon, which have been under pressure all year, are two of the top performers this month. Meanwhile, Apple and United Health, two of the year's best performing Dow components, are down more than 4% apiece. In fact, Apple's down 8%. And tech stocks overall are slumping today. Facebook, Nvidia, Broadcom, all down as investors take some profit off the table. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Tax reform, as we've been reporting, is another issue important to the market. This week, Republicans plan to outline their tax reform plan, offering the first concrete details of a proposal they hope will accelerate the economy. Congressman Kevin Brady says the plan will offer specifics.
You're going to see details around a broader range of a simplified tax plan for families where 9 out of 10 Americans will be able to use a simple postcard-style system to file their taxes, and the lowest rates on businesses in modern history.
Ilan Mui is with us to talk now about some of those details and what they might be. Good to see you, Ilan, as always. So
good to see you, Sue.
What do we know about the plan so far?
Well, the formal plan will be unveiled on Wednesday, but a few details have already started to leak out. I'm told to expect a 20% corporate tax rate as well as a 25% rate on so-called pass-through businesses, many of which are small businesses. One point that does seem to still be under contention, though, is what the top rate for individuals will be. The White House, I'm told, has been pushing to lower that top rate to 35%, but there is some concern that that could be seen as violating the president's pledge to focus any tax cuts on the middle class rather than on the wealthy.
Speaking of tax cuts, do we have any idea how they plan to pay for tax cuts?
Well, that is literally the trillion-dollar question, Sue. So what Representative Brady has said is that they are seeking as much permanence as possible, and that's important because in order to ensure that tax cuts last beyond 10 years, they have to find a way to pay for those tax cuts. So it's likely that some of the provisions might be temporary in order to ensure that the numbers can work.
You know, the Republicans have really been struggling to unite around health care. Is it looking better for tax reform?
they're taking a very different approach when it comes to tax reform. The Ways and Means Committee, which is the tax writing committee in the House, has been having a 2-day tax reform retreat. A broader conference of House Republicans is going to be meeting on Wednesday in order to talk about this. The president is making a speech on Wednesday in Indiana, so they're doing a lot more to lay the groundwork for those discussions and to get everyone on board. We will see if it makes a difference.
We will see. Thank you, Elon, as always. Elon Mui in Washington. And on Capitol Hill, a hearing on the Graham-Cassidy health care bill was immediately interrupted by protesters. The hearing was suspended for about 15 minutes while the demonstrators were taken out of the room after Chairman Orrin Hatch repeatedly called for order. When the hearing did get underway, bill co-sponsor Senator Lindsey Graham testified, as did Democratic Senator Mazie Hirono, who was recently diagnosed with stage 4 kidney cancer.
My goal is to get the money and power out of Washington, closer to where people live, so they'll have a voice about the most important thing in their life.
Health care is a right. It is a right. It is not a privilege reserved for those who can afford it. But Graham-Cassidy treats health care like a commodity that can be bought and sold.
Revisions were made to the bill over the weekend, adding billions of extra dollars for some states and easing coverage requirements to win over wavering GOP senators. Well, investors are hoping for a burst of economic growth, but according to a new survey from the National Association for Business Economics, most economists aren't so sure. Steve Leisman has the details.
We're bringing it from 1% up to 4%, and I actually think we can go higher than 4%. I think you can go to 5 or 6%.
That was candidate Trump extolling the potential benefits of his proposed fiscal policy. But 8 months into his presidency, many economists don't think that's the case. The latest forecast from the National Association for Business Economics says growth this year and next will be just 2.3%. It's higher than 2016, but far short of candidate and President Trump's estimates. The total effect of fiscal policies, NABE economists on average say they add just 0.25% to growth.
If we get a tax reform that is revenue neutral, doesn't add significantly to budget deficits in the long run, and it does lower corporate tax rates, then over the next 10 years, yeah, roughly at most a 0.25 point per annum additional growth. I think that's optimistic.
Even conservative economists don't see much upside from the president's fiscal policies.
If you look at the academic literature on tax reform, you can get at the upper bound about 0.5 percentage point per year over the long term. It's rare that something as pure as those things gets through a Congress by the nature of the political process, so you start scaling back from there.
Much depends on how much tax cuts boost deficits. They could end up raising interest rates or strengthening the dollar if they're not offset, and that would undo positive growth effects. But deficit-neutral tax cuts will get higher marks from economists, but they're unlikely to mark those forecasts up as high as 3%. For Nightly Business Report, I'm Steve Leisman.
The president of the New York Fed says weak inflation won't last, and that could lead to further interest rate hikes. Bill Dudley is among the first Fed officials to speak publicly since the central bank's decision last week to hold rates steady, at least for now. Mr. Dudley believes that inflation will rise and stabilize around the central bank's target of about 2% over the medium term. And if interest rates do rise, mortgage rates could follow, potentially reversing the historically low levels that home buyers have enjoyed. Low mortgage rates, along with stiff buyer competition, have helped fuel sky-high home prices over the past year. But there may be a limit to how much prices can go up. Diana Olick explains why.
There is so much demand for housing and so few homes for sale that prices have nowhere to go but up. And rock-bottom mortgage rates are only adding to the inflation. But all those factors are now facing something more fundamental. Some people just can't pay that much for a house.
First-time buyers are being priced out of the market, and their share has fallen from traditional rates. We haven't seen any real inventory increases in starter homes. What inventory we do see come on the market is generally above a $200,000, $250,000 price point. So it's an expensive market.
After hitting a peak in March of this year, national price gains month to month have been coming down. In July, which was the latest read on home prices, the gain compared to a year ago stabilized at 6.2%. That annual price gain had been accelerating in every other month this year, according to Black Knight Financial Services. Historically, home prices have always lagged sales, and sales have been falling for the last several months.
What we saw earlier in the year is that the market was transacting about 9 days faster than last year. Now it's down to 5 days. So we are seeing a narrowing of that seller's advantage.
While prices are not falling, the gains are cooling, and the competition among buyers is starting to ease. Here in the Washington, D.C. area, where home prices had been hitting new peaks for a year, they're now falling, down over 5% in July compared to a year ago. Realtors in this D.C. neighborhood say they're surprised to see the lack of a post-Labor Day bump. Usually both buyers and sellers get more active at the start of the fall season. But even the less pricey homes are now sitting longer. For Nightly Business Report, I'm Diana Olick in Washington.
Still ahead, this holiday season means shopping, and for some Target workers, a bigger paycheck. A cyber attack at one of the Big Four accounting firms may have revealed confidential client information. Deloitte believes the hackers may have gained access through its email server. The company contacted authorities immediately after it discovered the attack and said it notified each of the very few clients impacted. A global investor group is calling for an independent investigation into a cyber breach at the SEC. The Investment Company Institute, or ICI, is also urging the regulator to delay the submission of new monthly performance data rules until it can assure investors that its systems are secure. The ICI represents more than 95 million shareholders who hold more than $20 trillion in assets. Today, the SEC chairman said he believes the software fix has been successful. Target is raising its minimum hourly wage to $11 from a current rate of $10, and it vows to push it even higher in the coming years. This as the retailer looks for ways to attract and retain workers amid the tightening labor market. Courtney Reagan has more.
Target giving its employees an early holiday gift. A raise. The big box retailer is bumping its minimum hourly pay to $11 in October for both current and new employees, with plans to pay $15 an hour by the end of 2020. That means all 100,000 seasonal holiday employees will start at a higher wage. It's the third time in 3 years that Target has raised wages. $11 an hour puts Target above the minimum wage in 48 states, matching Washington and Massachusetts' rate, well above the federal minimum wage of $7.25.
This is extremely good for the customer, and it's extremely good for retailers because it feels like they have finally gotten the message that it is time to reinvest in the frontline sales associate. Even in an omni-channel world where business is clearly moving online, that frontline sales associate is still a very important position for retailers, and I think Target recognized that.
Target hinted at investing in its team at February's Investor Day as part of its 3-year, $7 billion plan to improve its entire experience from the store to the website. The move has likely been in the plans for some time, as the big box retailer still plans to hit its profit forecast even with the higher cost of labor. But Target is far from the first to announce pay raises for hourly employees. Last year, Walmart began a nearly $3 billion 2-year plan to bump up hourly pay for its workers. New employees start at $9, then bump up to $10 an hour after training, plus annual raises. Walmart's pay gets a lot of attention as the country's largest private employer, but Gap was the first major retailer to raise its minimum wage for store associates at Gap, Old Navy, and Banana Republic. It's hard to know exactly how higher wages help increase sales for retailers, but some experts point to Walmart's higher wages and its subsequent higher sales as no coincidence, suggesting happier employees are more helpful to both customers and their companies. While there are many retailers that are struggling and closing stores, the number of store openings still outweighs those shutting this year. Couple that with low unemployment and high turnover in retail jobs, and it's a challenging environment to attract and hold on to good workers. Target is hoping its competitive pay will hit a bullseye with its employees and eventually lead to happier shoppers, too. For Nightly Business Report, I'm Courtney Reagan.
T-Mobile wants Sprint, but only at market value, and that's where we begin tonight's market focus. Last week, we told you that T-Mobile and Sprint were reportedly in active merger talks. Today, Bloomberg said Sprint shareholders shouldn't expect a big premium if the companies entered into a stock-for-stock deal. The report said Sprint's largest shareholder, SoftBank, would agree to a deal that values the company at current market prices. Well, Sprint shares fell nearly 8% to $7.82. The FDA has rejected Johnson & Johnson's rheumatoid arthritis drug, saying it needs more information to evaluate its safety. J&J said it plans to work with that agency to win approval. Johnson & Johnson shares fell 22 cents to $131.17. Drug maker Allergan said it's launching a $2 billion share buyback. The company also said its chief financial officer would retire. Allergan shares rose 3% to $211.61. Outfront Media said it was recommended to be awarded a new contract with the New York Metropolitan Transportation Authority, the largest public transit authority in the U.S. The advertising company currently holds the licenses for ads in the MTA's network of subways, railways, and buses. The new deal would be for another 10 years. The shares popped 15% to $24.26. And after the bell, Ascena Retail posted a surprise profit and stronger than expected revenue. The parent company of Ann Taylor and Dress Barn did report a drop in same-store sales, but said it is making efforts to improve results. Shares of the small cap initially took off, and after hours, they ended the regular session up a fraction to $2.17. Preliminary ratings for Sunday's NFL games were down from the previous year. That's true for NBC's primetime game as well as Fox's afternoon matchup. But on CBS, ratings were up from last year's Week 3 coverage. Football ratings have been in decline well before yesterday's coverage. But the same is not true for the value of most football franchises. They've been rising. Robert Frank explains.
Television ratings for the NFL may be falling slightly, but the value of NFL teams continues to soar, driven by a growing number of rich corporate sponsorship deals. The 32 NFL teams are now worth a combined $100 billion. That's up 8% from last year, and the top 10 teams are up even more. According to the Forbes list, the Dallas Cowboys remain the most valuable team in American sports, worth $4.8 billion, and nearly double its value from 5 years ago. Owner Jerry Jones' creative deal-making, things like selling tickets and sponsorships at its practice facility, generated total profits of $350 million last year. The New England Patriots ranked second, now worth $3.7 billion, with their merchandise sales up 50% after that big Super Bowl comeback last year. The NFL teams made $7.5 billion from media and TV deals last year. That's about half the league's revenue. And new platforms like Amazon and Verizon could add even more in the coming years. But stadiums remain the big cash cows. Miami Dolphins got a $250 million naming rights deal with the Hard Rock, and the Atlanta Falcons saw their value jump 19% after securing $900 million in sponsorships for their new Mercedes-Benz Stadium. All that explains why 19 of the NFL team owners are now billionaires. For Nightly Business Report, I'm Robert Frank.
Dean Crutchfield joins us now to talk more about the NFL, sponsorships, and what to do when you find yourself caught in the middle. He is a brand expert with his own firm, the Dean Crutchfield Company. Nice to see you again, Dean. Welcome back.
Great to be back. Thanks for having me.
The NFL has frequently found itself kind of caught in the middle, whether it's social issues or other issues. This latest weekend event, no exception to that. But if you are a sponsor, say a Nike or an Anheuser-Busch, how do you walk the line between the controversy and your customers and your employees?
It's a great question. I think that we live in interesting times is one statement, but I think the other is that we are living in a highly politicized culture. And for a lot of marketeers, especially at these big brands, it's uncharted territory. It could easily be explosive, and they're trying to manage their own brand values. They don't want those taken away from them. So it really is, it's a big issue for them in terms of how they handle themselves. The most important thing for any of these brands to remember is that there is no study out there that shows a political stance adds to brand growth. If anything, the studies show it can actually have a negative impact on your stock value. So there's no proof of that. But most importantly, brands shouldn't be getting involved in politics. Brands are not politicians. They do not operate on a divide and conquer strategy. They actually have built their success by creating common ground. So that's where they need to take their stand.
You say they need a crisis management approach, prepare for the worst and hope for the best.
Absolutely. What more can you say? I think they need to have, they need to have a great plan. They need to be thinking fast right now. They need to have a clear purpose in terms of what their response will be, and they need to be bold when they do it. That's pretty much the nuts and bolts of crisis management. So they just need to be able to work that out.
Does it matter what the crisis is?
No, crisis is the same thing. You have to handle the expectations. That's why you plan it. You have to have a team in place, infrastructure in place for when that crisis hits. You then have to be, putting together a purpose-driven plan that talks about you as a business, as your brand, your purpose, not about the political climate. And then, of course, it needs to be bold. I think some statements were made today from Nike talking about the freedom of expression of the sports players in the game. So those statements are already coming out.
Dean, are you surprised that we haven't seen a more collaborative effort from some of these sponsors? Because they all sponsor, pretty much the same types of events, sporting events, whether you're talking football, whether you're talking baseball, whether you're talking, soccer, European football. I'm kind of surprised there isn't a more united front from them.
I agree with you. Obviously, there are some that wouldn't do that, of course, with the Cokes and the Pepsis of the world. But I think there's a lot of opportunity. This would not be collusion. This would just be people of big brands having a discussion, whether it's the chief executive officer or the head of marketing, having a wholesome conversation about the situation and what advice, what plans have others got in terms of their response to it. So I'm very surprised that hasn't happened. But I think maybe you might find behind closed doors conversations have happened.
On that note, Dean, it's always a pleasure to have you with us.
Thank
Dean Crutchfield with the Dean Crutchfield Company. Coming up, Google and Facebook tighten their grip on the digital ad market, but it comes as scrutiny of those same companies intensifies. Uber's CEO issued an apology to Londoners today. In a letter first published in a London newspaper, he wrote, "While Uber has revolutionized the way people move in cities around the world, it's equally true that we've got things wrong along the way. On behalf of everyone at Uber globally, I apologize for the mistakes that we've made." As we reported Friday, London's Transport Authority said it would not renew Uber's license when it expires at the end of September. Uber said it plans to challenge that decision in court. Disney is threatening to pull its programming from the fourth largest U.S. cable distributor. Disney and Altice, better known as Optimum, are working on a new contract to replace the old one that expires at the end of the month. Altice says Disney is asking for hundreds of millions of dollars in new fees to be able to carry channels like ESPN and ABC, even as ratings decline. Disney disagrees with Altice's characterization of the fee increase. And at this week's Advertising Week, anxiety is running high, not just among television networks and their declining ratings, but also among some of the most powerful ad giants like Facebook and Google. Julia Borston is in New York City tonight.
This year, digital ad dollars will grow 16%, surpassing all other types of media for the first time, according to eMarketer. But this tipping point comes as Facebook and Google, which together draw almost 2/3 of digital ad dollars, face unprecedented scrutiny. The two companies are under attack for a range of issues, from audience mismeasurement to concerns about violent and extremist content being streamed on Facebook and YouTube, and the role Russian-purchased Facebook ads played in manipulating the election. but it hasn't impacted Facebook's bottom line.
We very much invest in Facebook. We think it's a fantastic place to advertise, along, by the way, with YouTube and Snap and Twitter. We really focus about where people spend their time.
Despite all those negative headlines about Facebook, its shares are up by about 1/3 over the past 12 months, as the company has repeatedly beat analysts' expectations.
There's certainly been brands who have threatened in the short term to pull advertising, but ultimately brands want to be where consumers are. And Facebook, YouTube, they're really, really popular.
And after an advertiser boycott of YouTube this past spring, both Google and Facebook have announced changes to improve accountability and measurement.
We expanded some of the relationships with our third-party measurement partners to ensure that brands can better see the sales lift of their programs on our platform, which is more important than ever.
Today, Facebook's Instagram announced it's added 100 million users faster than ever to 800 million monthly active users and 500 million daily active users. That reach helping it grow its advertiser base to 2 million, double the number it had in March. With that reach, advertisers such as Unilever are following consumers.
TV isn't an area where we're pulling away from. We're increasing investment on digital, but it's more of a balancing rather than a major shift.
One ad agency CEO tells me that brands are going to continue to move towards digital targeting capabilities. And these latest political issues just mean they'll demand maximum accountability from Facebook and others. For Nightly Business Report, I'm Julia Borston at Advertising Week in New York.
And finally tonight, the world's most valuable brands. Interbrand is out with its annual list, and technology dominates. In the top spot, you guessed it, Apple. Alphabet's Google is number 2, and Microsoft comes in at number 3. Facebook was number 8, breaking into the top 10 for the first time. And of the top 10, Coke, Toyota, and Mercedes-Benz were the only non-tech brands. On that note, that will do it for Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us. Have a great evening, and we will see you right here tomorrow.